Welcome, everyone. We might get underway. Look, just to let everybody know, this session is actually being recorded, and the recording will stop though when we start the question and answer. We have a whole range of people that watch this after hours in particular, which probably shows small business and how busy people are. So this is being recorded. But firstly, welcome everybody, and I'd like to thank you for joining what's going to be a phenomenal session today with Deloitte, talking about tax planning opportunities and strategies. And we've got two terrific people, Alex Quinn, Senior Manager for Private Tax and Advisory, and also James Hudson, who's Senior Manager for Tax Core, online with us today as well. But firstly, I'd like to begin by acknowledging the traditional custodians of the land that we're meeting on today. Pay respects to their leaders past, present and emerging. And look, one thing we know about tax is that how often things change. And the tax system is a complicated beast, and it's very easy to get ourselves into strife with it. That's why companies like Deloitte are so important, because they can help us through understanding what's changed, what's new and what's different. And this is the perfect time of the year to really get our heads around what's going to be an important tax time, isn't it? So look, without any further chatter from me, let me pass across to the people that really know, now those at Deloitte, and I'll pass to Alex Quinn, Senior Manager for Private Tax and Advisory.
Thanks, Michael, and thanks for having us. Just a quick bit of housekeeping. As Michael mentioned, you've got myself, Alex, and James on the call. We deal day in, day out with private businesses and the families that own them. So we're well equipped to go through this session today. By way of agenda, what we're going to look at first is to kind of start from the bottom and build up. So we'll talk about some of the common structures and considerations depending on what structure your business has around it. James will then go a little bit deeper into the world of trusts and a few tips and traps that you should consider when dealing in those types of structures. Then we'll touch on some of the ATO focus areas for private groups, which has definitely become more of a focus in the last few years from them, before we finish with a bit of Q&A, and then we'll wrap up the session by around 10:30. So diving into structures, and we'll go through a few areas to focus on shortly, but the common structures which we see are listed on the screen. So quite often people will choose to set up in these for different reasons, but they are companies, trusts, partnerships, individual or sole trader. And then off to the side as an investment vehicle, you've got super funds, which we quite often see self-managed super funds or industry super funds, where your money is pooled with a lot of other members around the country for future benefit. So some of the considerations that we wanted to speak through today, and given the amount of time we've got, we're going to be relatively high level, but it's just to get you thinking about opportunities that might present as we approach 30 June, being the end of the financial year. So for companies during the last few years in the COVID pandemic, the government made some decisions around tax relief, if you like, which was definitely beneficial to companies. One of the main concessions that they've brought in and have relatively recently extended out to 30 June 2023 was the temporary full expensing measure, which allowed an instant asset depreciation deduction for eligible business assets. So when considering that, it's important to make sure that it is an eligible business asset and it is going to be used, in carrying on a business. The only, I suppose, trick there is that the motor vehicle limit of around 64,500 for FY23 should be considered if you're using this measure. So you can't go out and buy a 200,000 Maserati and claim the whole lot. And also in thinking about motor vehicles, just how much of that is being used in the business and the interrelation between fringe benefits tax as well. So definitely consider that as we approach 30 June, and then we've obviously got another 12 months of it leading into 30 June 2023 to consider. Another concession that the government brought in was the loss carryback provision. And what this effectively allowed you to do is that if you had a loss in the FY21 or FY22 year, you could look to offset that loss in earlier years where you may have had a profit. So for example, if you had a profit and you paid tax in FY19 or FY20 and you had a loss in FY21 or FY22, there was an ability to go back and utilize that loss. So quite often what we saw and have seen in the last year and for the year we're about to finish is the interrelation between the temporary full expensing measure and the loss carryback provision. So quite often an organisation would look to make a significant investment in capital and access the temporary full expensing measure. That would create a tax loss in their structure. But if they had earlier year profits, they'd be able to then offset that and be able to get back the tax that they paid in that earlier year. So it's definitely something to consider as we approach 30 June, and it's important that you look at what your taxable position is looking like. But the good news is you've got obviously this current financial year and next year to consider the temporary full expensing and the loss carryback, obviously this year and last year as well. Another area that we see as being important for companies is the tax rate that's going to be eligible for you. So over the last few years, they've slowly reduced down the small business tax rate to where we are now in the current year, which is 25%. So that's moved from 30% to 25%. That's for base rate entities. So they're entities who are carrying on business as opposed to entities who have got investment income who, if that's, above 80%, that's taxed at 30% still. So one factor to consider with tax rates and depending on the structure of your group is the franking credits that are attached to dividends when they're declared and paid. So if you're operating in a trading business and you're a small business entity accessing the 25% tax rate, any dividends paid out will be at that 25% franking rate if you've got available franking credits. Whereas, either larger businesses who don't access that 25% rate or investment entities will quite often have a different franking rate. So they're important considerations when those are going either to a trust ownership or out to individuals as to what the franking credits attached are going to be. Another thing to consider for trust entities, and this mainly applies to discretionary trusts, which we see quite common within our groups, often referred to as a family trust, just to make sure you've got a valid distribution before 30 June each year, which is a requirement. James will touch on this in a bit more detail later in the presentation. And another thing that we quite often see being incorrectly done is making relevant family trust elections. So this is important if you want to distribute out franking credits from a trust entity, or if you've got losses in a family group that you want to be able to distribute into those loss-making structures. So it's just something to consider. Obviously, with the limited time, we can't dive into examples, but it's worth reviewing each year. Moving on to partnerships and individuals, quite often what we see with a partnership structure is that it's either between individuals or sometimes between discretionary trusts. So it's definitely a structure worth considering depending on different factors. And quite commonly what we see with individuals and sole traders who start out in that structure, as they grow, obviously there's some factors to consider, such as tax profile, asset protection, commercial considerations, and the cost of doing business. So what we recommend there is that it's important that you review your structure regularly to make sure it is still appropriate. Quite often with a sole trader type environment, it might have been appropriate at the time of setting up, but as your business grows and becomes a bit more complex, it might not necessarily be fit for purpose moving forward. So definitely something to consider, and it might make sense to then move that structure into a company or a trust, for example. And just wrapping up on the structure section, super funds are something that we see relatively, well, most people obviously have a super fund, but self-managed super funds as well are quite common within our client base. And like everything, there's some things that need to happen pre-30 June or should be considered pre-30 June. One of those is the ability to make a concessional contribution into your super fund. So for the FY22 year, the concessional contributions cap is 25,500, and the benefit of that is that your structure or individually can get a tax deduction for that, assuming there's a notice of intent from the super fund. So that's a quite common strategy to put that money and make sure it clears the super fund before 30 June. Another thing to consider, and definitely something as people approach retirement and want to top up their super if they've got available money, is the ability to use the non-concessional contributions cap. So you don't get a deduction for that, but it's an ability to put more money into super and build that balance up for retirement. So for FY22, the non-concessional contributions cap is 110,000. And there's an ability, as you'll see below, to use the bring forward rule if you meet certain conditions, where you can put 3 years worth of non-concessional contributions in, so 330,000. Another relatively new initiative that's been extended out is the downsizer contribution scheme. So this is where currently members over 65 or older might sell their house and make the option to contribute an element of the proceeds into super. So that's up to 300,000, and that can be done for each individual. So hypothetically, if you've got a couple who sell their house, there's an ability for them to put 600,000 into super, assuming they meet the relevant conditions, which definitely worth looking into. And from 1 July 2022, they'll lower that age to 60. So I've seen it with a few clients where they're looking to sell the family home that they've been in for longer than 10 years, and there's ability to top up their super as they approach retirement. And the benefit of that is that the tax rates in super, while in accumulation mode, are capped at 15%, and once you're into pension mode, will be tax free. Another thing to consider as we approach 30 June is if you do have a pension within your super fund, just to make sure that the minimum pension payments have been made. So definitely consult your advisors or consider that if it's relevant to you. And as we touched on earlier, there's opportunities with small businesses to restructure and access restructure rollover relief in certain situations where they might want to move from one structure to another. So definitely worth considering. There's obviously hoops that you need to jump through, but if you're not happy with your current structure and you think there's reasons to change that, it's definitely worth a conversation to see if it's appropriate and possible. We're now going to dive into some of the year-end planning opportunities and considerations for business. So this is really probably more focused and targeted at organisations who are carrying on a business, and what can they do pre-30 June, and what should they be doing pre-30 June as they approach the end of financial year. So I'll run through these and use some examples where possible. So the timing of income derivation, it's important that you review whether your business is operating on a cash versus accrual method. Quite often we see with businesses, they receive income in advance. So it's important to consider the treatment of that income received. And factors that are important there are, are the funds, refundable if the service isn't provided. In the situation where they're non-refundable, that income should be actually brought into account in that year. Timing of expenses. So generally, to be deductible, you need to incur the expense, in that relevant financial year. But I think a common misconception with small business, especially, is that expense needs to be paid. That's not always the case. If you've incurred the expenditure, you've got a relevant tax invoice, and you pay it after 30 June, there's an ability to claim that deduction in the current financial year. Likewise with provisions, provisions and accruals are quite often referred to as estimates, where you're estimating a future deduction. Generally, they're not deductible in the year, so quite often you'll see annual leave and long service leave being accrued in a relevant year. The deduction won't come to effect until it's actually paid, so worth considering that. Not a nice thing for businesses to consider, but bad debts, if you know the debt has gone bad, it's worth making that kind of formal record and writing that off before 30 June, so that you can at least access the deduction for that. So worth reviewing your trade receivables as we approach 30 June and making any calls there. Another consideration is around trading stock. So choosing the most appropriate valuation method at 30 June. So looking at, is it cost? Is it market selling value? Is it replacement price? Do we have any stock that is no longer, valued at what it was maybe, 2, 3, 6 months ago? If we're in the business of, fresh produce or things that go out of date, is there any stock that should be written off, down to zero if it's got no, selling value? As touched on earlier with superannuation, if you want to get the deduction for super, it needs to have, left your bank account and cleared at the super fund level before 30 June. So definitely recommend, if you're looking for that additional deduction in the current financial year, making sure you've paid that at least a week before 30 June is recommended to allow enough time for that to go through. And it's also a common trap that if super is paid late, and generally the due date is by the 28th of the following month. So for super due, 30 June, it needs to be paid, and cleared by the 28th of July. If that's paid late, technically that super deduction isn't deductible. So it's a very common thing where super is just sometimes paid late, and sometimes it can be because the clearing houses take a few days for it to process, but definitely worth being on top of that and making sure that you make those payments on time so that you get the deduction. Another major reform that we're seeing is increases to super guarantee, and as at 1 July 2022, so just around the corner, the super guarantee rate will go from 10% up to 10.5%, and there's further increases that are stepped out over the next couple of years. So as employees, what you should be doing is factoring in this into, obviously, checking your employment agreements, seeing how this increase in super is going to affect your current arrangements with staff. Because 9 times out of 10, what it actually means is that there's an additional cost that the business is going to have to wear, because most employment arrangements are generally quoted, agreed salary plus super. So if super is going up by 0.5, that's an extra 0.5% added to the business. And another thing to consider for organisations with casual staff is that the 450 de minimis threshold per month for super guarantee is being removed. So if you employ staff and you might pay them, only a couple of $100 during a month, there's no requirement for super. Whereas from 1 July, there'll be a requirement, the first dollar that they earn. So definitely worth looking at that for organisations that have casual staff. A few more things to go through before I hand over to James, but a very common thing we see is personal exertion income and maybe incorrect treatment by some people. So personal services income, the best example is situations like a doctor, for example, where they might They might be in a structure such as a company or trust, but it's important that they're being paid the appropriate amount out of that structure, and that they're not trying to either distribute to favourable beneficiaries, for example, a wife, or retaining money in the structure, for example, a company, and getting a tax benefit. So definitely something to consider if that structure is applicable to you, and just making sure that you're doing what's consistent with the ATO's thinking. One of the most common things we see in the clients that we deal with is money being taken out of companies. So effectively, the shareholders or the directors taking funds from the company. So that's not necessarily an issue, but where it's done over a period of time and the funds aren't repaid, it can create a Div 7A exposure, which is a tax term. So what we do with a lot of our clients is we determine the appropriate strategy for dealing with that Division 7A exposure. So options that we quite often look at is, can the funds be repaid? Do we look to declare a dividend? If the amount withdrawn is quite significant, quite often they'll look to put that loan on a complying loan agreement and deal with it over either a 7 or a 25-year period, depending on the arrangement. And another option that I've seen organisations do is actually contribute an asset into the company with a relevant market value. Another important thing to consider is if there's been a sale of an investment or a capital gain event during the year. So definitely a trap that I've seen organisations fall into here is that a contract might be entered into in one financial year, but the settlement occurs in a subsequent year. For capital gains, we need to look at the contract date. So that can quite often have a timing difference, and the ATO is definitely hot on that topic. Another thing to consider is whether you've held the asset for 12 months or longer, and if it's on capital account. If that's the situation, you can access the 50% discount, which can reduce that gain down, which can be quite beneficial. And another thing with small business is planning and utilising the small business capital gain concessions if and when the time comes to sell your business. So it's something you need to plan for, not just a month before you're planning on selling your business. It's worth considering and structuring appropriately so that you can maximise the benefits there. And just to finish, something that's going to be relevant for most individuals when they're doing their tax return at tax time is the consideration of the working from home deductions and what the methods are. So the ATO obviously announced a higher rate per hour, if you like. It's kind of a COVID shortcut method, which is 80 cents per hour from home. And generally they're comfortable with that being, in diary form. But what I've quite often seen, because that 80%, that includes pretty much everything: telephone, internet, electricity, depreciation on furniture, etc. Quite often what I've seen is that you can get a higher deduction using an alternative rate. So if you're using your telephone and internet at a higher rate, or you've purchased some, equipment for your work office, you can then use the actual cost method or a fixed rate method and get a much better deduction. So just worth considering those as we approach 30 June. I'll now hand over to James, who's going to dive into the lovely world of trusts.
Thanks very much, Alex. Yes, so trusts. So I guess best to give a bit of context before I dive into a bit of the detail. So unlike corporate structures where the corporate vehicle itself is taxed, trusts, generally speaking, what's called flow-through vehicles. being liable for tax. It's generally ensuring that it is actually the beneficiaries that are going to be taxed, not the trustee. Because in order to get that treatment, there are a few hoops to overcome or get through, and we often see them missed in practice, actually. So the first one is proper distribution resolutions or minutes. So when preparing these, it's very important that you would review the trust deed and that these minutes and resolutions are executed before 30 June. So if in the absence of a default distribution clause in the trust deed, which may or may not be there, if these aren't prepared or they are ineffective, the trustee is actually going to be taxed at the top marginal tax rate of currently 47%. And also they don't get the benefit of the capital gains discount that if that capital gain was distributed to a resident individual would effectively halve their tax. So there is a permanent tax cost of not getting this right. So sort of things I would look out for when preparing the minutes or looking through the minutes that your accountants have prepared for you is just making sure they've looked through the trust deed and made sure that the trust isn't distributing to a beneficiary that's not in a class of eligible beneficiaries or is specifically excluded. And other things to look for are sometimes what will happen is the accountant might prepare a minute where most of the income is distributed to a corporate or also known as a bucket company, as this often has a lower tax rate than an individual, and the capital gains that have the CGT discount benefit, i.e. halving your tax liability, stream to individuals. In order to stream, however, the trust deed itself needs to have the specific power expressly provided in it. Without that in your trust deed, the streaming will be ineffective. So important to consider that. And as Alex flagged before, with most family trusts, or most discretionary trusts anyway, they are family trusts, and that has the benefit of being able to receive and distribute franking credits, and also has benefits for carrying forward tax losses. However, it does reduce the pool of beneficiaries that you can distribute to effectively your family members. Jump to the next slide, Alex. So other trust structures we see are unit trust, and they're reasonably common in the private space, but they are deceptively quite complex and difficult. And in addition to my comments on effective resolutions, whilst noting that often unit trusts do have a default distribution clause, there's other tricks and traps you need to watch out for. So again, just a little bit of context. A unit trust is a trust where basically the beneficiary's entitlement to income and or capital of the trust has been unitized, i.e. a unit trust. So things to look out for are a capital gains event called CGT event E4. And what happens with that capital gains event is that where the trust distributes non-assessable, or I guess non-taxable income to beneficiaries, this can actually erode a unit holder's tax cost base in their unit. And if, say, that unit, well, the cost base in that unit is completely eroded, the excess is actually taxable. So I think a way to think about this as well, and how this can arise, especially currently with the current measures in place, is that if businesses have been utilizing these immediate asset write-offs, where for tax purposes the business has been getting large deductions for these asset purchases, and then still, but for accounting purposes and the cash available, they've still got the cash to distribute. This can significantly erode or create capital gains event for unit holders. So it's something to sort of look out for. You know, there's ways to manage this through how you would how much cash you would distribute to beneficiaries and how you would draft your minutes, but just keep an eye out for it. The other trap, I guess, or trick with unit trusts as well is winding up a structure. There's you can run into problems, or a problem called the inside out problem. And what happens with the inside out problem is where your cost base in the units is greater than the cost base of the unit trust asset. So the unit trust would sell the asset, create a capital gain, and distribute that capital gain, and it'd all be taxable. But you've got cost base in your units, and you want to be able to use that cost base to reduce your capital gain. So what we'd have to do is actually, in order to use your cost base in the units and not be taxed on something more than your actual economic gain, you'd need to wind up the unit trust in the same income year. So another trick to watch out for that's not very commonly known. Next slide. Thanks, Alex. So another sort of quite recent matter to look out for is in February 2022, the ATO has released a suite of tax rulings, guidance, and tax alerts. These rulings primarily related to Section 100A that I'll go to further soon, and also Division 7A, so TD 2022 D1. And I won't go into detail on this, but all that TD is purporting to do is effectively remove a concession that a concession on the timing that arose where a discretionary trust or a trust would distribute to a bucket company and create Division 7A issues. So the ATOs that received some concessional treatment, and the ATO under this TD is looking to remove that concession. If you could go to the next slide, Alex. So what is Section 100A? So I've got a list of the elements on the slide, but if I was to put it, you know, I guess in broader, more general terms, Section 100A is really seeking to punish situations where a discretionary trust, or it could potentially be a unit trust, but generally discretionary family trusts, where the family trust directs income, taxable income, to a individual that is typically on a lower tax rate, and that individual doesn't actually receive the income or the cash. So like a very common scenario with some families would be where a child turns 18, the mum and dad each earn relatively high amount of income, and the child earns next to nothing. The family trust distributes all the income to the child. It uses its tax-free threshold and its lower tax rates, and significantly reduces the overall tax burden for the family. Now, unless there are specific sort of circumstances in place. Under the ATO's recent guidance, they'll seek to attack that type of arrangement under section 100A. Next slide, thanks, Alex. So this is a ever evolving beast at the moment. The tax community had been expecting these rulings. However, I guess the breadth and the interpretation that the ATO has given under these rulings is probably more aggressive than what was expected, and there's been significant feedback, and there's talks of rewriting some of the rulings. Most of them are all in draft form at the moment, but I guess I just wanted to outline some arrangements that if you entered into these, it would be my view, even after potential rewrites of these rulings, you might be in a bit of trouble. So the first arrangement is the one I essentially outlined above, where you've effectively directed all the taxable income from a discretionary trust to an individual on a lower tax rate, and that individual doesn't actually receive the benefit of the income. The second arrangement is where, probably through a bit of play with streaming certain types of income, you've managed a situation where an individual on a lower tax rate has actually received a large amount of taxable income, but their income under accounting or normal concepts that they can actually sort of grab from the trust is significantly less. The ATO's, with that sort of arrangement, the ATO would also want to see like a deliberate attempt to avoid tax, but that's another one to look out for. One other is in relation to unit trusts. So with unit trusts, what you can do is, say, distribute to an individual or probably more likely a company, and instead of actually paying that amount or distributing the amount to the company, you issue units in lieu of that cash and set off the amount owing from the unit trust to the company against the amount owing from the company to the unit trust for the issued units. So there's actually effectively no cash transactions, and the unit trust gets to keep the benefit of the cash. And the other one to watch out for is where you're distributing, and probably there has been, you'd also, in this situation, there wouldn't be a pattern of this previously, but you wouldn't want a situation where you're distributing to loss entities. So you're not distributing to an entity that has carry forward losses, and you just distribute it to that entity to soak up the losses. Next slide. So this is just hot off the press, and I put this slide in this morning, just with all the activity around 100A and the rulings on LinkedIn. Actually, the Deputy Commissioner of Tax, Louise Clark, has said that the ATO will be releasing a fact sheet to tax practitioners just to help resolve some of the uncertainty that has arisen out of the ATO publishing all these guidelines. And that's set to be released before 30 June this year. So when you speak to your accountant, sort of, I'd be making sure that they are aware that this fact sheet is going to be released and have reviewed this fact sheet before preparing distribution or setting your distribution strategy. Thanks, Alex.
Thanks, James. So to kind of finish up before we open up for a bit of Q&A and then wrap up the session, we thought it'd be worth going through some of the key focus areas of the ATO, and this is specific for private clients and the families that fall behind them. So I'll go through a couple before handing over to James, but definitely through recent ATO activity, I've seen a few reviews and audits in the past kind of 12 to 18 months, and one of the hot areas that they're really focusing in on, as touched earlier, was Division 7A. So that's where you've either got use of a company asset, for example, if you had a property in a company or a boat in a company, and you've got shareholders or associates or directors having some benefit to that, or the most common example where we see money being taken out of companies and not being adequately dealt with. So Division 7A, for larger family groups especially, it's a very common issue, and it can be easily dealt with, but the ATO definitely like to focus in on that area to ensure that documentation supports what's actually happened, or that requirements are being met in a timely manner. Another area of focus for them is the misuse of self-managed super funds. So a few examples here of what they're looking at. Obviously with super funds, the sole purpose test relates to obviously, providing for your retirement, but they try and avoid situations where assets are being purchased in the super fund that might have a personal benefit. So things like, art collections, if you decide to buy art in your self-managed super fund, you can't then hang that art in, your business or your home. It would need to be held kind of, in a neutral spot. Things like buying a residential house and then having a family member rent it. These are common things that they're trying to avoid. So just important, if you do have a self-managed super fund, that you're aware of the do's and the don'ts. Another very common area that the ATO seem to be focusing in on is the misuse and inappropriate access of certain concessions. So Division 40, that relates to effectively the depreciation deductions that you're eligible for. So, with all of the concessions that the government has allowed over the last few years, being, temporary full expensing and instant asset write-off, what they're honing in on is that if you are claiming those deductions, that you've actually considered that you're meeting all of the relevant requirements. So, was the asset actually ready for use when you started to depreciate it? Do you have a valid tax invoice to support it, which is made out, to the correct entity who bought the asset and has recorded the deduction? And with the different dates that these concessions came in, they're making sure that, your treatment matches the period that the concessions were allowed. And then R&D, that relates to research and development. So just ensuring that the research and development actually meets the eligibility requirements before you then lodge that claim. So I'll pass over to you, James, to wrap up the last few areas of focus from the ATO.
Thanks again, Alex. So number 3 is I guess property development, and the issue here that they're focusing on is the benefit that you can get through reporting to say something's on capital account, because potentially on your structure you can get access to that CGT discount, which will effectively halve the tax that you pay on realization of a property. So with property development, in its strict sense, where you say you buy a property or build a property with the purpose to sell it for a profit, that would be on revenue account. and be subject to ultimately be subject to tax at individual marginal tax rates without the benefit of the CGT discount. The where something could be on capital account is if it was purchased to say rent out, and the purpose behind developing this property is to derive rent, not actually sell the property for a profit. But if you are in the property development space and you wish to argue this, you'd need to be able to evidence that purpose, and you'd want sort of very strong evidence, because the ATO is really onto this. The other one, number 4, is sort of business versus hobby. Sort of what springs to mind is I guess barristers, and they start up, say, a winery as a bit of a hobby and make significant losses because they're not very great at at making wine, but they use those losses to offset their business income that they earn from being a barrister. There's special rules to prevent the deduction of what's called non-commercial losses. So it doesn't need to be a winery. It could be horses, a plane, a hobby plane, or even sort of a boat, for instance, that they may charter out. Number 5 is cross-border arrangements and offshore structures. So just quickly with offshore structures with businesses, how would I put it? So transfer pricing, and what that is targeting is where the business is looking to shift its profits to a jurisdiction with a lower tax rate. So it's important that you can sort of justify your cross-border payments to it. Otherwise, you could face significant penalties from the ATO. Other one is inbound finance. So where you've got finance from overseas coming to an Australian entity, there's rules to prevent claiming too many tax deductions when the entity is too overly capitalized with debt. And the other one is IP transfers. So where IP has been developed in Australia and transferred, say, to another jurisdiction that had more concessional tax treatments for IP. Sorry. Guess the thinking about this is with offshore structures and cross-border payments, generally the principle is we want these to be arm's length. And would an Australian company ever really wish to transfer its valuable IP offshore? Sorry. So the final one is internal restructures and atypical transactions. So with this one, just making sure you get tax advice when you undertake these internal restructures and transactions. Even rationalizing loans and forgiving loans can have significant tax consequences. So
I'll jump in and give you a bit of a chop out, James, in case you've got any more
Thanks, Alec.
any more coughs. But yeah, with atypical transactions, the ATO, it's another area of focus that if you're buying and selling, and a lot of the time it relates to commercial or residential property, they're hot. It's a hot topic for them. They are able to now data match with a lot of the state revenue officers, so they know when a property's been sold, and what you'll see at an individual level, if it's held individually, is that those property sales will actually come up on the ATO annual pre-fill reports, which your tax agent can see. So I suppose the message there is, if you've sold a property, if it's your main residence, great, there's a main residence exemption. But if it was used to derive income, or it was an investment, then you know, the ATO are going to be aware of it. So it's just important that you deal with that correctly. And it comes back to that point earlier around contract versus settlement date, because that's going to affect when the gain occurred, and allowing you to plan accordingly for recording that gain, and depending on the ownership, you know, planning on how you're going to distribute that gain. So I think that's probably it from a focus area of the ATO for private clients. We might end the recording there, Karen,